Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, "Millionaires don't need astrologers, but billionaires do." And so we begin. It's Wednesday, April 24th, 2024. Not really any news coming out today. Maybe the biggest thing was the Meta earnings, and we'll go over that and the charts and potential implications. Later this week, very, very important reports coming out that could really shake things up. Thursday, Q1, quarter one GDP coming out, and Friday, the PCE data, personal consumption expenditures. Are people spending a lot of money or not? We will see. The first chart I want to go over that I've been using for a lot of shows recently is the weekly. So each candle is 1 week of the S&P 500. I've been noting that we have a potential 3 black crows here. Red candle, larger, red candle, larger, red candle after breaking out of a longer wedge. It looks very, very bearish. And if this candle for the week stays within this red candle, that's a healthy bear market signal. If we actually, funny enough, if this drops lower, it actually gives the chance for it to bounce back higher. But if we close within this red candle here, it's kind of saying, yeah, okay, we had a healthy break here and we're still paused, and then we'll have a chance to roll over. This is a very important chart, I think, to be keeping your eye on. Fear index getting slightly less fearful by 1 point, but still in the fear zone. HYT, high yield corporate, the money that smaller companies are borrowing, they have to pay a higher yield on it. This is the best leading indicator for where things might be going. I said yesterday, 2 days ago, I said that, we might be testing this candle right here that was from April 11th. And we did. I nailed it right on the head. I thought we were going to test the bottom of the red part of the candle, but we tested the wick of this previous candle right there. And I suspected we would break down from here, and so far that has played out to be true. It looks like to me this will keep going down, mostly because of these 3 increasingly large red candles back from last Thursday, Friday, and the following Monday. So the bears are in control, right? Well, where's the run to safety? Oddly, the 30-year Treasury yield went up again today to sort of test a very recent high around 4.8% in the 30-year bond. I had mentioned back a long time actually ago that I had a target between 4.7 and 4.8, and so I will be surprised if we go above 4.8 here. I do think that this may be a longer term top in the long duration yields, and I am actually betting pretty big on this, but not in the way that I care so much if it keeps going up, because if it does keep going up, it just means I'll keep adding to it. I'll increase the size of it in my portfolio. Right now I have 45%. I bought a lot of treasury bonds again today, and I'm at 45% in a fund called Zero Z, which holds long duration treasury bonds. Again, the basics of this: the higher the yield, the lower the price of the bonds go, and when the yields go down, the price of the bonds that exist go up in order to match whatever the current yield is. It really is looking like things will be playing out exactly to my favor. The stock market will be going down from here, and we will finally see a proper run to safety in treasuries. I'm quite sure of it. That's the majority of what I had for us today. There's a few notable big stocks to talk about that I wanted to bring up briefly. Again, I talked about Tesla after the close yesterday and how silly it was that, their revenue was a surprise, like massive decline. In other words, the money coming into the company dropped hugely. But you give Elon Musk a microphone and he talked Tesla up 13%, saying, "Oh no, hey guys, we're going to come out with these cars that everybody can, the cheaper end of the EV market." And so people got excited. Again, this is like casino action here. This isn't smart money making this thing bounce. The smart money that had Tesla shares are dumping their shares into the laps of the poor retailers who are likely to get crushed from this. But remember, this is just my opinion. It's not like I'm the guy with the crystal. Meanwhile, Meta apparently doesn't have such a good spokesperson. There's I can't believe this number. It wasn't that far down just like a few minutes ago. 16% and falling. Losing 16% on what's the market cap of this company now? A $1.3 trillion company just lost 16% of its value. Well, friends, welcome to the casino. I'm a little bit speechless here. But it's also not surprising. When PE ratios get out of hand while the Fed's trying to strangle the markets, it's like you should expect crashes like this. Certainly, especially in the semiconductor space. Meta, what is their PE right? Their PE ratio right now is 33. So that's very high. It's not like 200, 300, but that's still very high. A company like this normally would be maybe I might buy Meta shares if the PE is at like 20, but I'd have to look over the history of earnings too and check for like an average over the, past 10 years or so to really gauge if I am interested in purchasing it. But wow, 16%. That's a very large move. I'm going to calculate that out real quick. Yeah, so that is 1.25 trillion was the market cap. 16% of that, $200 billion change in the value of that company in a flash. Fascinating. How's that affecting the NASDAQ as a whole? Let's check out the triple Qs after hours. Of course, this is the after hours, what's going on after the market already closed. And yes, you can see the entire NASDAQ drop is down about 1.35%. So be careful, folks out there. Hold on to your hats. Things are getting crazy. Meanwhile, I found a stock that looks like it might be at a decent valuation. Speaking of car companies, Nissan Motor Company. Now, as far as charts go and chart patterns, I'm not a genius when it comes to drawing trend lines, but this thing starting in 1982, we've hit it in 82, 98, 2009, 2020, and again in 2022. We're not hitting it now. I don't know if we're gonna hit it. We may hit it. I don't know. I don't care. I just was looking over the valuations of this company. But before we get to that point, I want to mention, one aspect, one thing that can give you properly, I think, a good impression of a company is how long it's been around. Go for a drive. You will see Nissan cars. I don't think this company is going out of business. And, do I want to risk my whole portfolio in a company like this? No, because any company can go out of business. But look at what this company has survived. It survived all of the 80s and everything that happened in the 80s, all of the 90s. It survived the dot-com bubble. It survived the great financial crisis. It survived the COVID collapse, the COVID bubble. And here we are at a valuation of, right now the PE ratio is 5. And if we take a look at the 10-year average of its earnings per share, I like to try to figure out, well, what would the price be if it had a normal low PE ratio of 7? And that price would be $9.38. Right now it is $7.11. And so I think this is a nice little stock that I found, potentially highly undervalued. The fear of this company, the car industry as a whole is very competitive, and so it's hard to get an edge, similar to airlines. It's not great that the actual price of the shares were not that much lower than they are right now, all the way back in 2000. And and there are issues. They seem to have a lot of debt, but this seems to be an ongoing problem through the whole company's history, and I really don't think they're going anywhere anytime soon. I personally think Nissan vehicles have a good place in the market. They're generally, especially if we see a slowdown and people are trying to, like, how do I save money? Buy a Nissan, right? Anyway, yeah, so about a little bit over a 1% allocation to that in my portfolio I put in yesterday, I think. Anyway, that's all I have for you for today. I hope you enjoyed watching. Thank you for watching, and I'll see you next time. Robschild.